Welcome again to our Financial Wellness channel. Thank you for those of you who subscribed to our recent videos and viewed and shared with your friends. As usual, I'm your coach, financial coach, CPA Tonie Njiru. And today we shall continue with our discussion on investment in SACCOs. And today we'll be discussing about the SACCO balance sheet. How are SACCOs funded? How are SACCOs generating the monies that they're able to pay? So that you can have a better understanding when you're investing in a SACCO, what to look for in terms of the returns and whether they are sustainable. So when you talk of a balance sheet, we are basically looking at a statement that shows what an entity owns vis-a-vis how they have funded what they own. So in essence, what you're talking of is assets. That is what we own and how we have funded them, primarily being the liabilities, the capital that we have contributed, because these are the funds that are used to procure the assets of the organization. So SACCOs, in terms of assets, the largest asset that a SACCO has is the member loans, the loans that they have advanced members. So in talk of an asset, we are looking at a resource that we control. So what does the SACCO control that they can say is their own asset, from which of course we expect future economic benefits to flow to us. So the largest resource that a SACCO has is loans to members. It's their largest asset. So it's very important for us to ask now as investors, how do we procure these loans from the SACCOs and at what rate? And I will use an illustration that, for example, if a SACCO lends at 1% per month, which is usually what we call the normal rate of loans for SACCOs. SACCOs have many products, but what we call normal loans, all SACCOs will have this type of loan that has an interest at 1% per month or 12% per year, reducing balance. So if you're to borrow 1%, and you can see the computation we are showing there on the screen, if you're to borrow 1% at 1% per month, borrow 100,000 over 48 months, that is 4 years, you'd be expected to pay back 2,633 every month. So at the end of the 4 years or the 48 months, you'd have paid a total of 126,402. And because you had borrowed 100,000, your total interest would come to 26,402. And if you take an average per year over the 4 years, every year the interest is 6,600, giving you a rate on the 100,000 you had borrowed of 6.6% per annum. So in terms of lending, SACCOs have a low rate. So for you to access credit for other investments, and later on we shall be talking about active investments, one of the channels or the ways of accessing affordable credit is through SACCOs. And you, of course, need to have invested so that you are able to get such a loan. If again, we are to look at a SACCO that is lending at 1.5% per month, because SACCO loans will range from 12 to 18%. You're not likely to find a loan going beyond that rate. That is in Kenya, for those who are in Kenya. At 1.5% per month, and it's important we mention at this point that in other countries, instead of the term SACCO, you will hear them using the term credit unions. But in Kenya, we use SACCOs, and the cooperative movement in Kenya, of course, has done very well. We are number 1 in Africa and number 7 in the world. So in terms of cooperatives, I'm sure many Kenyans have benefited from this. So if you're not benefiting from this, you should join a SACCO. You should look for us so that we can advise you on how you can better your investments in the SACCO. So a SACCO that is lending at 1.5% per month, as you can see on the screen, or 18% per annum, for a loan of 100,000 every month, you would be paying 2,938 shillings. That is for a 48-month period. That would be 4 years. So by the end of the 4 years, you have repaid a total of 141,024 shillings. So the total interest, having borrowed 100,000, would be 41,024 shillings, giving you interest per year of 10,256. Effective rate, the effective rate would be 10.3% per annum. Now, if you look at a rate of 10.3% or 6.6% for a loan of 1% per month or 12% per annum, the rates of lending are quite low compared to the rates of dividends and interest that we were mentioning in our earlier video. And the purpose of this video is to explain the sustainability of the SACCOs. So I would want you to be very keen that we are saying the rates that which we are charging the loans, we range from 6.6% effective, 10.3%. Yet in terms of giving returns to members, SACCOs are able to give up to 20% on share capital and up to around 13% for deposits. So we will seek to demystify how SACCOs are able to do this and if this is sustainable. So on one side of the balance sheet, as we have mentioned, is the asset side, and our largest asset is the loans to members, because in a SACCO perspective, when we lend our members, we have invested in the members. And SACCOs are expected to primarily be for the members. So our core goal should be to lend to members. Our core goal should be to lend to members. However, should we have excess funds, as we shall mention later on, it is possible to have other investments, and it is advisable for SACCOs to look for those other investments. Now, in terms of capital, which is the funding, when you talk of financial capital, it is an economic resource that is measured in terms of money, which is used to now acquire the assets that belong to this SACCO. So SACCOs primarily have two types of capital. They have what we call core capital, and they have what we call borrowed capital. So the core capital of a SACCO is again divided into two. We may have a third classification, but generally we have two categories under core capital. That is contributed capital, which we mentioned in our earlier video. When you're investing in a SACCO, you put in what we call minimum share capital, which you may increase or not. That is known as contributed capital. As per the law, this capital is not refundable. So you cannot get back your money, and when you exit, you can only sell it. So the only way you can recover your money is by selling it. Now, contributed share capital can only be recovered through sale of your shares or transfer of your shares to someone else. The contributed capital has a minimum. So every SACCO, before you join a SACCO, is important for you to know how much is the minimum for you to become a member. And it has several characteristics. One, it acts as a barrier to entry. If a SACCO puts or sets its minimum contributed share capital very high, then it is very hard for them to attract new members. Because if, for instance, the minimum share capital is £1,000,000, it means that they have to look for members who can be able to afford £1,000,000 for them to be able to invest in the SACCO. So it acts as a barrier to entry. So a SACCO ordinarily will not want to set a very high share capital, because then it will prevent members from joining. It also acts as a barrier to exit. If the amount is substantial enough, you're not willing to leave the SACCO and leave your money. So it is important that the SACCO sets a reasonable amount that members will feel pain if they have to leave this money in the SACCO. Thirdly is that this share capital earns you dividends within the SACCO. And because we have said it's not refundable, it is the foundation of the SACCO. So the SACCO is assured that this money will always remain there. It gives the SACCO what we call stability. It gives the SACCO stability. And for the regulated SACCOs, then SASRA will require us to maintain certain percentages of this share capital as a proportion of the total assets. And as such SACCOs, we need to make sure that as the assets are growing, then the capital is also growing. So ordinarily what SACCOs will do is that they may choose to increase their minimum share capital. Other SACCOs will set a minimum, but then they will require every person to add something small every year, so they make sure that their capital is growing. Other SACCOs will just set a minimum, and then they will allow those members who want to invest to do so. So SACCOs will be of two types in terms of contributed capital. We'll have what we call open-ended vehicles or SACCOs, which allow members to continuously buy more shares from the SACCO. And these are the majority. More than 90% of the SACCOs in Kenya are open-ended investment vehicles, which means they continue to issue more share capital. And you can always buy more shares from the SACCO. In such SACCOs, if you're in such a SACCO, then your shares, should you want to transfer them to someone else, can never be sold at a premium. They will not be capable of attracting capital gains, because the SACCO is also selling the same shares that you have. So that your shares can only sell at a discount should you want to transfer them for an open-ended SACCO. Then we have what we call the closed-end SACCOs. They are SACCOs that have capped their shares. They put in a limit. They say you cannot exceed this unless you are buying from another member. So buying directly from the SACCO, they have put a maximum. Examples of such SACCOs will include a SACCO like Tembo, which is a SACCO originally affiliated to the East African breweries. A SACCO like National Police SACCO, they have a cap beyond which they will not allow you to exceed. So for the closed-end vehicle SACCOs, and you cannot invest more than the maximum that they have set. And often some of them will set the maximum equivalent to the minimum so that everybody is at the same amount in terms of share capital. The other type of capital that forms our core capital is the institutional capital. Institutional capital is the retained earnings that have been plowed back into the SACCO over the years. This capital does not belong to any specific member. It should act as a barrier to exit. Anytime you want to exit the SACCO, you must remember that you will not get back your institutional capital. It is not transferable. You leave it within the SACCO. And as SACCOs grow, for older SACCOs, you'll find that this amount per member may run into hundreds of thousands. So it's very important to be aware of institutional capital. Another point to note about the institutional capital is that the money income generated from the institutional capital belongs to the SACCO. And this is what enables a SACCO to be able to pay higher rates of dividends and the rates of interest on the loans. So if, for instance, a SACCO is issuing loans at 10% and it has an institutional capital of 1 billion, so on average, it is generating 100 million from that institutional capital, which can now be used to top up the dividends that you will earn from your deposits or share capital. So that is a core capital. The third class under core capital, which we said we shall not emphasize on, is special projects funds, which arises where some SACCOs want to do some special projects away from the core business that probably is allowed by the regulator. So we shall not focus so much on that because ordinarily SACCOs under core capital will have contributed capital and institutional capital. And the purpose of this lesson for today is for us to understand the institutional capital is what enables SACCOs to be sustainable in terms of payments of dividends. Is what enables SACCOs to pay a rate that often appears like they are paying more than what they are generating in terms of the loans, because we are issuing loans at an affordable rate, but being able to pay a higher rate of dividends. So anytime you're joining a SACCO, it's always good to look at their financial statements, see whether they have built sufficient institutional capital, because if a SACCO is just out to compete, a young SACCO that tries to pay high dividends without sufficient institutional capital will eventually be swept or will be run down by the high rates of dividends and interest. But if a SACCO takes time to build its institutional capital and it has sufficient institutional capital, and then they are also able to invest this institutional capital wisely, then such a SACCO will be able to give a high rate of dividends, a high rate of return, is a good SACCO to invest in. The other way that SACCOs are funded is through borrowed capital. That is member deposits is our largest borrowing. We borrow money from members. We can also borrow externally from banks. So anytime, again, it's good for a SACCO to be able to utilize the member deposits. If you find a SACCO that is borrowing from the bank, it's an indication that either the members are not financing the SACCO sufficiently, or members are borrowing more than they are investing in the SACCO. Now, it's very, very important for us to appreciate that nature of investment in SACCOs, and how do then SACCOs apply their funding. So ordinarily, SACCOs are formed primarily for the members. So as we mentioned, our largest asset is in the members. However, a good SACCO is able to invest again away from the member as a way of diversification. We must ask ourselves what would happen if the members are not able to repay their loans, maybe because the sector we are in has been affected, like the sugar sector. We have had SACCOs that were in the sugar sector, SACCOs like Nyando SACCO, in Muhoroni, Koru. We have had SACCOs like Chemerir, for Chemerir Sugar. So such SACCOs, if they have not invested again away from the members, they will find themselves struggling when the entire industry is in struggle. So it is very, very important for SACCOs to also be able to invest within the law, because there is a very narrow scope of where SACCOs can invest away from the members. So our primary target should be to give loans to members because they are the owners of the society and because members are sufficiently diversified. So when you give loans to members, there are members who invest in agriculture, others in trade, some of them even in auctioneering, so that when the economy is not doing well, some members are also making money. But away from that, as a SACCO, it's important there's a direct relationship between our capitalization and our returns. So a SACCO that has sufficiently invested in good, in terms of institutional capital, then should be able to meet members' returns, to give members returns, even when the members are struggling in the industry. And we are showing you there an example of a society that this is was a housing cooperative society that is generating, that had a building where they were generating 26.4 million shillings per year, or 2.2 million shillings per month. From this building, they would distribute all the returns to the members. And being a housing cooperative, there was not so much restriction. It's not a SACCO, it's a housing cooperative. So for 6 years, they had a tenant and they were collecting 26.4 million. Then after the 6 years, the 7th year, the tenant decided to leave and gave them notice and left the property. So their income came down from 26.4 million to only 0.3 million per annum. And they now got to a point where they were struggling to give members any dividends or interest. So what you're seeing there is a schedule we were working out with them. What if over the 6 years when they were making money, they decided to invest, use 2.4 million for their operating expenses, then they would invest 12 million in government bonds. We have taken a conservative rate of 13%, and then they would distribute to the members for the remaining 12 million. So over the 6 years, if they compounded, as you can see on your screen there, by the end of 6 years, they would have accumulated an investment of 112 million, having invested 72 million. So they would have generated an additional 40 million. Now, after the tenant left, the next phase of 6 years, when they have not gotten any tenant, they could be able to pay half of the interest they are receiving from the bonds as dividends, and they capitalize half. So by the end of the next 6 years, having paid the members 72 million in the first 6 years, in the second phase, they would pay the members another 50 million, and they would have investment in bonds that would have grown to 164 million, in addition to the building. So the building is not bringing any money, but they still now have another investment of 164 million because of taking the initial steps to invest the institutional capital. So as an investor in a SACCO, it's very good that you participate in governance. We say the general meetings, the delegate system. If you're in a delegate system, it's also very important that your leaders are able to invest the institutional capital wisely, so that they're able to give stability to the institutional capital. I've also shown a screen there, an example. This is our last example of a SACCO that decides to be investing 3 million shillings in bonds at 14.3% net every month. And at the end of 12 years, having invested 3 million, so every year is 36 million. At the end of 12 years, they will have accumulated 1.14 billion shillings in bonds, that from the next year they would be generating a return of 163 million every year. So if subsequently they stop adding more money into that fund, by the end of 20 years they would have 3.3 billion invested away from the members. Out of an investment of 432 million, their money would have grown to 3.3 billion, generating 476 million per year, which means they can recover their money from the interest paid by the government for only 1 year. So if SACCOs have such progressive investment programs, then they are able to sustain the payments of dividends and the payments of returns. So it's always very good. Analyze your SACCO before you choose a SACCO that you're going to invest in. Make sure that the SACCO you're investing in is a SACCO that has a sound leadership, that is investing right. As usual, this is your coach, CPA Tonie Njiru. Thank you very much for listening to us and following us. We shall be, in the next episode, be a very brief episode discussing how you can compound your personal investments in the SACCO to grow your own returns. Thank you very much for listening to us. Kindly subscribe to our channel, share with your friends, follow us on the social media platforms, that is on YouTube, TikTok, Facebook, and Instagram. Thank you.